Welcome to the Deep Dive. Today we are tearing into the Q3 2025 earnings call for Caleres Inc.
Yep. The company behind Famous Footwear, Sam Edelman, and now Stuart Weitzman.
And this call, which dropped pre-market on December 9th, it delivered one of the steepest market punishments we've seen all earnings season.
Oh, it was absolutely brutal. The stock saw this instantaneous, dramatic drop. I think it was over 20% intraday.
Yeah, and it settled down nearly 10% by the close. And when you look at the financials, you kind of get why the market panicked.
You really do. It's a classic Jekyll and Hyde scenario. The revenue looks great, but then you see this massive, shocking collapse in profitability.
And that's our mission today. We have to look past that surface volatility and really understand the core conflict here.
Right.
What forces are strong enough to drive that top line beat, but at the same time, just destroy the bottom line and force a guidance cut that severe?
We're looking for the signal in, the deafening noise of acquisition costs and these big structural headwinds.
Okay, so let's start with the headline numbers, because they tell that story of divergence right away. Revenue was a definitive win.
It really was. Sales came in at $790.1 million. That's a 6.6% jump year over year.
So they beat consensus.
By a lot, almost 3%. It shows the consumers, still buying their stuff.
But then you hit the bottom line, and all that enthusiasm just evaporates instantly. Adjusted earnings per share.
The number the market really cares about.
Exactly. It landed at just $0.38.
And that is the source of all the pain. Consensus expectations were way, way higher, somewhere in the range of 75 to 85 cents.
So missing by half, that's not a slight miss.
No, that's a structural profitability failure for the quarter. That's why the stock reacted the way it did.
And when we dig into the core profitability, the collapse is just astonishing. Operating earnings were only $12.0 million for the quarter.
Put that in context, yeah. That translates to an operating margin of just 1.5%.
1.5?
And you have to compare that to the same quarter last year when they delivered an 8% operating margin.
So a five-fold reduction in efficiency, that signals some really severe pressure.
You can't sustain growth targets with that kind of profitability. You're basically just running in place.
Okay, so strong revenue, weak margin. Let's break down the business and see what's driving the growth and what's, draining the cash.
The clear bright spot, and where management is really focused, is the brand portfolio segment.
This is their big pivot, right, towards a premium multi-brand platform.
Exactly, and the numbers totally back it up. Organic sales for the segment were up a solid 4.6%.
And that's without the new acquisition.
Right. If you factor in the acquisition, growth just rockets up to 18.8% year over year.
They're winning where they want to win. I saw they called out Sam Edelman as being exceptional.
Yeah, management said Sam Edelman had its best quarter ever in owned e-commerce.
Wow.
And if you zoom out, the whole brand portfolio gained 50 basis points of market share in women's fashion footwear.
That's critical. It really is. It reinforces their whole argument that this shift to premium direct-to-consumer is working.
Absolutely. And it's now generating more than half of their operating earnings.
But on the other side of the coin, you've got Famous Footwear. That's the structural counterweight, and it's dragging things down.
It is. Sales there declined 2.2% year over year, and comps were down 1.2%.
So what's the story there? Is it just a declining business?
I wouldn't call it a total failure. Think of it more like a stability engine. Management did note that trends were improving sequentially.
Okay.
And they saw huge success with the premium brands inside Famous Footwear, like Jordan and Birkenstock.
So if the brand portfolio is the high growth engine, Famous Footwear is the operational backbone, the cash cow.
Exactly. It provides the stable cash flow they need to fund the whole transformation. And they're being pretty disciplined with it.
What do you mean by that?
Well, they're actively editing some of the underperforming labels to free up what they call open to buy.
Okay, break that down for us. For anyone who doesn't live and breathe retail inventory, what's open to buy?
It's basically the budget or the liquidity. They have to go buy new inventory for next season.
Got it.
So by clearing out the stuff that isn't selling, they free up that cash to make sure they're stocking new products that will actually move.
So it's a necessary move, but it still signals that there's pressure in that lower price segment.
For sure.
Okay. So we've got internal strength and some calculated pressure, but that margin collapse points to something bigger, something external or highly transactional.
And that brings us to the true heart of the profitability crisis.
The Stuart Weitzman acquisition.
Yep. Closed back in August for about $109 million. This is where the immediate painful dilution is coming from.
How bad is it?
It's clearly causing massive short-term strain. We know this because management actually gave the number. If you strip out the effects of SW,
Okay.
adjusted EPS for Q3 would have been 0 to 67 cents.
Wait a minute. They reported 38 cents,
Right.
and without SW, it would have been 67 cents.
Yep. That means the Stuart Weitzman deal diluted earnings by nearly 30 cents in a single quarter.
A massive drag.
Why such a devastating impact so quickly? What's going on there?
It's really a combination of two big factors. First, you have temporary integration costs. They're operating under what's called a transition service agreement, a TSA.
And the TSA is basically,
It's a costly temporary contract where the seller, in this case, Tapestry, is still running some of the infrastructure.
like IT systems or logistics.
Exactly. Until Caleres can fully integrate the brand. So it means you have these duplicative elevated costs. You're paying two parties to do one job.
So that TSA cost is transient. It'll eventually go away. What's the second more painful factor?
The inventory issue. And this is the one that directly guts your gross margin.
Okay.
Management was very frank about it. They acknowledge they need to clear a ton of global excess and aged inventory, up to a third of the stock they acquired.
And clearing old inventory means one thing, massive discounting, which means margin compression. This ties directly back to why that operating margin just cratered to 1.5%.
So they're taking a huge short-term hit to clean the slate.
Precisely. They view it as momentary in nature. Their big strategic goal is to get Stuart Weitzman to break even by 2026.
But hold on a second. If it's all just momentary, why did their Q4 guidance include another 30 to 35 cents of dilution from SW?
And that's the skepticism you're feeling from the market.
Right. It doesn't sound like a quick cleanup.
It's not. The size of that Q4 expected loss, they guided to a loss between 35 and 40 cents per share. It shows the cleanup is not quick. It suggests the inventory glut is deeper or the TSA is more expensive than the market thought.
The entire Q4 loss is basically explained by Stuart Weitzman.
It completely overshadows the core business for the next 6 months.
So the dilution is bad, but that's an internal problem they chose to take on. They also have an external headwind, right? The tariffs on China-sourced products.
That structural cost is very real. Gross margin was compressed by 140 basis points year over year, and a huge chunk of that was tariffs.
And specifically for the brand portfolio, the growth engine.
The impact there was even worse. 175 basis points of gross margin hit in Q3 alone. It's a heavy, recurring tack on their best business.
That makes the whole profitability puzzle even harder. You have to clean up the SW mess and offset these tariffs. So what are they actually doing about it?
They're attacking it on two fronts. First is sourcing. They are aggressively reducing their reliance on China.
By how much?
The goal is less than 10% of sourced dollars coming from there by the end of 2025.
That's a huge logistical shift, but a necessary one. What's the second lever?
Good old-fashioned cost control, specifically SG&A. They're implementing a program to get $15 million in annualized cost savings.
Okay, $15 million. How much of that will they see this year?
About half, so $7.5 million.
And that $15 million is crucial. It's not just trimming fat. It's designed specifically to offset those sticky tariff costs.
Exactly. If they fail to deliver on those savings, the tariff headwind blows right through to the bottom line, and the path to recovery gets almost impossible. It's their commitment to the market that they can control their internal costs.
Okay, let's tie this all back to investor sentiment. The acquisition and tariffs explain the Q3 collapse, but the crazy sell-off was really driven by the forward outlook, the guidance reset.
This is where the street just lost faith. It was devastating. We mentioned the Q4 guidance, that loss of 35 to 40 cents, but the full year picture was the real trigger.
What did they guide for the full year?
Full year 2025 adjusted EPS was slashed to a range of just $55 to $0.60.
Oof, that is a staggering cut. It confirms this pain is much deeper and longer lasting than anyone predicted.
And management knew they had to give some context for that. They were very clear to point out that adjusted EPS, excluding Stuart Weitzman, is still projected to be robust.
What was that number?
$1.15 to $1.25.
So that number, the $1.15 to $1.25, is their core argument. They're telling the market the foundation is strong, but they're sacrificing half their profit for a year to integrate this luxury brand.
And that sets up this fascinating strategic trade-off. Management is calling it deliberate pain, necessary investment.
While the market is pricing in huge execution risk, the stock is down 52% over the last year. I mean, drastically lagging the S&P 500 and the retail ETF.
The market clearly does not buy the deliberate pain narrative. And the question is why, right?
Right.
The market looks at that 2026 break-even goal for SW and asks, what if they miss? Maybe the inventory cleanup takes longer, or the SG&A savings don't materialize. Either of those things pushes the recovery out another year.
So for an investor, the milestones are crystal clear. You need to see visible progress on what, 3 things?
I think so. First, that SW inventory has to come down. Second, you need to see evidence that the $15 million in SG&A savings is actually hitting the bottom line.
And third, they have to deliver on that 2026 Stuart Weitzman break-even goal.
Those are the metrics. They'll determine whether this sell-off was an overreaction or a justified repricing of a failing strategy.
All right, let's pivot to our final segment, where we pitch an outrageous but plausible trade idea based on what we just analyzed.
And as always, the crucial reminder, this is not financial advice.
Not a financial advice. We are just exploring scenarios based on this huge divergence between what management is saying and what the market is fearing. Do your own homework.
Okay, so what's the premise?
The premise is simple. The stock's been hammered. It's near 52-week lows. Management insists the core business is strong, and SW is a calculated short-term cost. The market is betting against them.
Which means if management executes even just a little bit better than these deeply negative expectations, there's significant upside.
Precisely. So we're pitching a strategic recovery spread.
Okay, give us the action.
It's a two-pronged action. First, you go long Caleres Inc. equity, ticker CAL. You're betting on the internal turnaround.
But you want to hedge against the broader retail sector.
Exactly. To hedge against things like consumer pressure or worsening tariffs, you simultaneously short the broader retail sector ETF, XRT.
So it's a pure relative value bet.
That's it. You're betting that the company will, at the very least, stop underperforming its peers.
The trade hinges entirely on management executing on those 2 levers we talked about.
The $15 million in SG&A savings and hitting the SW break-even goal. If they can do that and show a clear path back to that normalized, $1.15 plus EPS.
Yeah. The stock should immediately improve relative to the sector, and the spread pays off, no matter what the broader consumer market does.
It's a bet that the narrative will shift from structural failure back to strategic pivot.
Okay, so let's recap the deep dive. Caleres is successfully executing its pivot to premium and DTC. The revenue numbers and brand portfolio growth, they confirm this.
But the costs of that shift, the SW integration, the inventory cleanup, and the tariff pressure have just crushed margins and forced this deep guidance cut.
It's a huge divergence.
Yeah.
A growing premium business underneath, but with crushing short-term integration costs on top.
So what does this all mean for you? Well, the next 12 to 18 months will really tell the tale. Was the sell-off an overreaction to temporary strategic pain?
Or was it a justified repricing of a structural execution failure?
And given the deep discount now baked into the stock, you have to ask, is Caleres setting the bar low enough with its 2026 break-even goal to generate a surprise upside? Or are the headwinds from tariffs and Famous Footwear simply too powerful to overcome? That's the question that dictates the next move.